Why does the price of XYLD completely destroy QYLD? If you think you know the answer to this question, well, you're wrong. Well, at least I think you are. I have to be honest, guys, this one perplexed me for a while. We've talked in length about QYLD, QYLD's high yield, QYLD's investing strategy, and most recently, why the price of QYLD is always going down over time. QYLD's price launched at $25 per share back in December 2011 and has never risen above this price and currently trades around $17.68 per share. But why doesn't this happen with XYLD? The S&P 500 Covered Call ETF from GlobalX, which utilizes the exact same investing strategy as QYLD. I don't pretend to have all the answers, unless I'm talking to my kids. But I want to share with you my own theory as to why XYLD has done what QYLD has never accomplished over the past 10 plus years. Let's be clear on what we're talking about. QYLD and XYLD are both ETF investments offered by GlobalX. They operate the exact same investment strategy, but based on two different indexes. QYLD owns the underlying investments in the NASDAQ 100 index, and then writes covered call options at the money against the NASDAQ 100 index, ticker symbol NDX. XYLD owns the underlying investments in the S&P 500 index, and then writes covered call options against the S&P 500 index, ticker symbol SPX. They both maximize the option premium they receive by writing at-the-money monthly call options on their entire portfolio. This yields a significant amount of option premium, but also caps the amount the portfolio can grow. I highly recommend first watching the QYLD price video I recently made if you haven't seen it yet, because I get very granular and specific as to how QYLD's investment strategy is executed. Here's a link right above to that video if you want to start with that one, and then there will be a link at the end of that video to jump right to this one. Here is a quick refresher on how these ETFs work. The options contracts utilized by QYLD and XYLD are not the traditional QQQ or SPY ETF options. They are written against the NDX and the SPX indexes. This is significant because they are cash-settled options contracts that cannot be exercised early, known as European-style options. At the time of option expiration, there are no shares of any type of investment that are bought or sold. Instead, they are cash-settled. Every month, a new option contract is written at the money, and the majority of the option premium is distributed to investors as income. When the contracts expire, the contracts are either completely worthless to the buyer because the price of the index is lower than the strike price, or the price of the index is higher than the strike price. If the price is lower, then QYLD and XYLD get to keep 100% of the option premium. If the price is higher, then QYLD and XYLD have to pay money to the option buyer. The specific amount they would need to pay would be the difference between the current price at expiration and the strike price, multiplied by $100. We covered in that previous video that writing these at-the-money options makes it very difficult for QYLD to increase its share price since it pays out nearly the entire option premium to investors as a distribution. When looking at QYLD's stock price, the decline over time makes sense. Since the price of these ETFs is based on the net asset value, or NAV, and the majority of any new assets received gets distributed to investors, the price really never achieves any measurable increase. Here's the rub though. XYLD bucks this trend. XYLD was launched at just over $40 per share in June of 2011. Over the next 11 years, the price of XYLD dropped below this level only 2 times, in early 2016, in corresponding with a drop in the S&P 500, and again during the COVID crash of March 2020. Otherwise, this investment has been in the green. One cannot help but be astonished at the difference between these two charts. Most people, I think, jump to the conclusion rather quickly that this difference in share price can be completely explained by the difference in volatility between these two investments, but that's a premature conclusion in my opinion. Yes, there is no doubt that the NASDAQ 100 has experienced more volatility than the S&P 500 over the past 10 years. The data is clear. But this, I believe, has led to more option premium and thus a higher level of income for QYLD compared to XYLD. As you can see, historically over the past 5 years, and really looking back to when these funds were launched, QYLD has regularly offered a higher yield. Given the direct correlation between volatility and option premium, this makes sense. With that though, the large increases in price for the NASDAQ 100 compared to the S&P 500 from month to month can make it more difficult for QYLD. Remember from the previous QYLD video that every time the previous month's option contract settles in the money or above the strike price, QYLD and XYLD have to pay money to the option buyer. That money does not grow on trees. It has to come from either the option premium that was originally collected, or QYLD and XYLD have to sell assets to generate cash. This reduction in the NAV makes it harder for QYLD and XYLD to generate as much option premium as they did in the previous month. But why is XYLD different? I think there are two main reasons for this. Number one, the S&P 500 is overflowing with dividend-paying stocks. Over 400 of them to be specific. In contrast, only 51 of the NASDAQ 100 companies pay dividends, and the majority of the dividend yields for those are weak, with most less than 1 to 2%. I believe this is important because both of these ETFs primarily generate their distributions to investors from option premium. The overall dividend yield for the NASDAQ 100 is 0.59% compared to the S&P 500 at 1.41%. This difference is meaningful and I think a crucial reason why XYLD maintained its higher share price. Reinvested dividends, baby. Number two, QYLD has a track record of high dividend yield, and from the beginning, XYLD has not been seen as a super high dividend yield. QYLD has gone on record in the past and said it really tries to target a 12% yield. In my mind, QYLD has really made it difficult to periodically lower its dividend yield in order to reallocate assets to building up its net asset value and thus increase the future dividend payments and the share price. XYLD, on the other hand, doesn't have this problem. They have routinely offered a dividend yield below 10% over the past 5 to 10 years. I suspect that they have the ability to routinely reallocate assets if necessary to build up the NAV. I am totally speculating with this theory, by the way, but I do think it makes sense. By the way, if I was running an ETF like QYLD or XYLD, I would make one massive change to the portfolio strategy that would not only yield just as much as right now, but also provide downside protection. This unique strategy can also be run in your own portfolio on individual dividend stocks and index ETFs. Make sure to subscribe to this channel if you haven't already done so, as we are going to cover this strategy in the next video. Given the vast difference in share price between QYLD and XYLD, which one is better to own? Well, it completely depends on what you are trying to accomplish in your own portfolio. It might not make sense to own either one of them. Are you still growing your portfolio, or are you ready to live on the cash right now? I'm a firm believer that these ETFs, QYLD, XYLD, and RYLD, are best utilized when you need cash flow right now. If you're still building up your portfolio, I think you can do better. By the way, if you want to learn more about how you can retire on dividends faster than QYLD, check out this video right up here. Thanks for watching, and make sure to leave your 2 cents down in the comments.